Good afternoon and welcome to the latest webinar in the Infrastructure Journal webinar series, in which we will be discussing institutional investors and infrastructure in the US and exploring and identifying appetite for investment in infrastructure. I'm Sarah Tame, News Editor at Infrastructure Journal. I'll be chairing the session this afternoon. Before I introduce you to my esteemed colleagues on the panel, a few housekeeping rules. If you're having trouble hearing, please notify us by using the chat box on the GoToMeeting panel. We like these sessions to be as interactive as possible, so please feel free to ask questions using the questions function on the GoToMeeting panel throughout the session. Now, without further ado, I'd like to introduce you to our panel of experts. With me today, I have Vonda Brunsting, Deputy Director of the Capital Stewardship Program of the US Workers Union Service Employees International Union, Petya Nikolova, Executive Director and Head of Infrastructure from the New York City Retirement System, Marietta Moshi-Eshvili, Managing Director for pension provider TIAA-CREF, and Julia Harris, Managing Director at Investment Advisory PFM Group. I'd just like to hand over to you ladies to give me a brief introduction to what it is that you do at each of your organizations. Vonda, if I can start with you.
Sure. So good afternoon or good morning, everyone. This is Vonda Brunsting. I'm the Director of the Capital Stewardship Program at SEIU. The Service Employees International Union has 2 million members in the U.S., and we represent workers in the public sector as well as healthcare workers and property service workers. Our members participate in the public pension system in the U.S., and also many are in different Taft-Hartley pension funds. So my role in the union is to work with those pension funds, both around issues around retirement security, as well as working with our trustees who are the fiduciaries who sit on the boards of the funds. And my interest today is really in sort of furthering the work that we've done to encourage the pension funds in the U.S. to look at infrastructure as an investment opportunity. And we've provided a lot of education for our trustees as a way to get them comfortable with this new asset class and opportunity.
Thank you, Vonda. Petya?
Good morning, good afternoon. This is Petya Nikolova. I'm part of the New York City Retirement System Office of the Controller, which has 130 billion assets under management. We advise the fire retirement system, police, teachers, New York City employees, and Board of Education. My role in the organization is that I run the infrastructure asset class. It's a newly established program. It was adopted last December by our board, and now we are working on building the portfolio.
Thank you, Petya. Marietta?
Yes, thank you. My name is Marietta Moshi-Eshvili, and I'm a portfolio manager with infrastructure investments at TIAA-CREF. TIAA-CREF is one of the Fortune 100 financial services organization. We have more than 90 years of experience providing financial services to our clients. And our clients are 4 million participants at more than 15,000 institutions. We're one of only 3 insurance companies in the U.S. who are rated AAA, apart from S&P, given the rating of U.S. government bonds. And infrastructure investments are a very important part of our portfolio investment strategy. TIAA-CREF has over 480 billion under management. I've started our TIAA infrastructure strategy in 2008, and currently the portfolio may not be large compared to the rest of the assets under management, but it's very important, as I mentioned, and we have big aspirations for the capital allocation of private infrastructure investments.
Thank you, Marietta. And finally, Julia?
Hi, good morning, everyone. It's Julia Harris from Public Financial Management. Public Financial Management is the largest financial advisory firm in the United States. We have over 30 offices staffed by over almost 500 people across the country. Our focus is in 2 parts. It's on the financial advisory side on debt issuance and privatization strategies, as well as asset management. I am one of the co-chairs of the privatization group, focusing mostly on healthcare and higher ed, as well as infrastructure financing.
Thank you all and welcome. It's great to have you all on the panel. Just to set the scene a little, there's a growing need for infrastructure development in the US, and the federal government is advocating a push for infrastructure spending to spur economic growth. In 2013, the American Society of Civil Engineers gave US infrastructure a grade of D and warned that the country had serious problems with its infrastructure. And the problem much of the US faces is aging infrastructure. Road networks, bridges, rail networks, and various social infrastructure assets need upgrading. So the question is, who will pay for the upgrades? And one option is institutional capital, but what does US institutional investor appetite for infrastructure really look like? And are the products and platforms that will allow them to invest available? That is what I'm hoping we will find out in today's session. So to begin with, Julia, perhaps you can start us off and just give me a brief description of the demand for infrastructure funding in the US and where the need is for infrastructure development.
Sure. I mean, as you see on slide 2, there's just a huge need for capital investment across the United States. We've been working with state and municipal governments for our company for over 30 years. I've been in the business for over 19 years. And in the past, we've really only looked at debt issuance to help with our infrastructure needs. The business of infrastructure investing in the U.S. is still really new in a developing class, but we have seen a tremendous shift even over the last year, a development in the last year. We're finding our clients and governments across the board who have embraced the concept and demonstrated a willingness to really explore private capital across all asset classes. For example, there's more than 30 DOTs that have passed privatization legislation. Some, like in Florida, Texas, and Virginia, have healthy track records of deals that other states are hoping to emulate. We're also seeing a tremendous amount of movement in the student housing field, water and wastewater, and transit is becoming much more attractive with the opportunity to leverage TIAA loans. I think what we're finding with our clients, there's still issues. I mean, it's routinely now part of our analysis when we work with them that we do look at alternative funding methods such as privatization. But I think what we'll need to move farther and create more deal flow is a couple things. One is more deal standardization. We're finding that's necessary to really create a pipeline of investable opportunities. The return expectations of many funds are still somewhat high for our clients, especially, they're still thinking about their ability to issue debt and what their cost of capital is. The complexity of the deals, I mean, they're still very difficult, to structure and to manage once they're structured. And of course, the political risk, which, as my other panelists on the phone know, is always an issue regarding when these institutions will actually look at a possible transaction. But we are seeing lots of movement. Like I said, Allentown is a perfect example of the transaction we've been working on. It's a smaller deal, which of course is something else we can discuss. We're seeing a lot of smaller entities, not these big skyway deals with a BAFO that comes in around $200 million. So we are seeing a great amount of movement. I can't necessarily say that there's going to be huge deal flow over the next year or two, but we continually are looking at this with our clients, and they're open to the thought of alternative financing methods.
Great, thank you, Julia. So we know that there's a demand for infrastructure and that institutional investors are starting to look at infrastructure and that the market is looking at alternative sources of funding. But now let's look at it from an institutional investor's point of view, and what do investors define as infrastructure and why is it an important part of their investment portfolio? Petya, perhaps you can start us off here and tell me a little bit about what your organization defines as infrastructure and why it's an important part of the investment portfolio.
We have taken a broad approach to defining infrastructure. In other words, energy is part of infrastructure for us. Renewables are part of infrastructure, transportation, social infrastructure, P3s. However, what we focused more on and what we would like to see from these infrastructure assets is certain characteristics such as stable and predictable cash flows, monopolistic characteristics, essentiality of the services that the assets are providing. Therefore, if you have a power plant that is a merchant power plant, probably that's not part of our definition of infrastructure. The reason why we adopted the infrastructure policy and is an important part of our portfolio is that although there is somewhat limited data on correlation, the data shows that there is a lower correlation between infrastructure and the rest of the market, therefore providing diversification benefits for the portfolio. Also, it's important for us that we expect infrastructure to provide inflation protection and not also important is the fact that there is a match between long-term liabilities and the long-term cash flows from infrastructure. So I would say these are the three most important characteristics and benefits that we see of having infrastructure in our portfolio.
Okay, Marietta, do you have anything to add there? What's your point of view on that?
No, I fully agree. One of the reasons why we have committed to the platform of private equity type infrastructure investing is because of our institutional knowledge and experience in energy and project finance markets. We've been mostly a fixed income investor, and then we've been a fund investor and co-investor with a lot of our good fund managers. But what the management of my company wanted to achieve is a direct investment platform in infrastructure assets for a number of reasons that were already mentioned. I would also probably add that in addition to providing diversification, there was also a need to have more predictability of the funding, more control of the entry, and ability to exit from these investments, extending the duration versus having a finite life associated with these investments. So we do have a direct match to our long-term liabilities and linked to inflation and lowering the volatility of our portfolio. I think based on the skill sets we had internally, we've also had lessons learned as well as very positive experiences on the debt side that were needed to be transferred to the equity side of the inflation. We've noticed a lot of managers on the financial side and also strategic players define different assets as infrastructure. To our surprise, there were a few opportunistic assets that were deemed to be infrastructure for us. While it's a very diverse asset class, finds that there need to be certain characteristics that define whether the asset is matching the definition. And they include the inelasticity of the demand, the high barriers to entry, inflation-linked cash flows, and high degree of regulation. And because of that, we're actually very focused on developed markets. And I think we would consider emerging markets if we have local partners. Those would be more of an opportunistic approach in opportunities. But we've also found that there are certain characteristics that are pretty unique to a lot of our investments, even though they range from transmission lines to contracted power to regulated utilities or transportation infrastructure.
Right, thank you, Marietta. And Bonda, I mean, from the point of view of your members and the clients that you represent, what's their viewpoint of what is infrastructure?
Well, I don't know that I have much to add to the definitions that were offered, but I would say that just to follow up on Julia's comment, that we have seen a huge increase in the interest in finding new ways to finance infrastructure. From the perspective of the labor movement, there's an economic interest in creating jobs, which infrastructure offers. And so I think that what we're looking for from institutional investors and from our pension funds is how do we find a balance between providing the returns and the characteristics that people have mentioned, and really meeting the needs of a larger set of stakeholders. And so we want to have, as we find the financing mechanisms to finance infrastructure, certain public accountability, which would guard these projects, make sure that there's regulation in place and transparency, and then also making sure that the stakeholders are protected. Workers are able to retain their rights in the workplace, and then also the public sector doesn't suffer from any efforts to privatize or change the way that these assets are run. So I think that it's a challenging prospect to sort of move, and we've seen it happen very quickly into this new financing mechanisms. But I think that the challenge for us is on the pension fund side to meet the opportunity really, and have the returns and the stability and the long-term cash flow that would provide the diversification that the funds are looking for. At the same time, look at a wider set of stakeholders that really would benefit from increasing our ability to, move ourselves away from that D, and get the infrastructure needs of this country met, but at the same time protecting the public and workers while we do that.
Yeah. Okay, that's an interesting point. And that, yeah, Julia, please go ahead.
I just wanted to follow up on something Vonda said, which I think is really interesting, which I think really shocks our clients, is that when you do projects like this, the transparency that is created, or that the increased transparency is really shocking to them, that this is something that is going to be in the public eye, it's going to be scrutinized. And that's a double-edged sword for our clients, but I think it's really interesting. I think that's part of the reason why the Chicago Infrastructure Trust was created is, many of the Chicago transactions, monetizations were really done, and the public really didn't get to speak out on it, not only the public, but the city council. So, I mean, I think that many of our clients are really surprised by the thought that this, how transparent these transactions are and have to be in order to be successful. But I just want to follow up on Vonda's comment.
No, that's really interesting, and I wonder if we can perhaps move on to talk about kind of a bit more in detail about the challenges that are facing investors that want to invest in infrastructure. I mean, Vonda, you brought up some interesting points there. Is there anything else that you feel that is particularly challenging?
I'm sorry, are you referring, this is Vonda. Are you asking me that
Hi,
question, sir?
Yeah. Yes, yeah. So
Okay.
Vonda, I mean, is there anything else that you wanted to, that you feel that is particularly challenging in addition to the comments that you just made?
Well, I think that from the perspective of the pension funds, which is sort of my view of this, is trying to really ramp up both the capacity and the resources of the fund. Many of them don't have staffing. I think, Petya, it's great that she's in New York City, and having people like her with the capacity at the staff level of the fund to really go out and look for deals and to evaluate them and do due diligence is important. I think the trustees is one of the areas we've been working to try to get them up to speed and really develop a skill set there for them as a board member to make a decision about these. I think that the other challenge is really on the financing structure, and what we saw years ago was a private equity fund model where through a privatization the different managers would pool money and then buy these assets up, and the return structure really didn't meet the needs and the risk of what the pension funds were looking for. And so I think there's been a lot of movement as well on that front to find new ways to finance some of these opportunities. And I think that the work that has been happening in the West Coast with the West Coast Infrastructure Exchange is very hopeful, and it really points to, I think, one of the, I guess, another opportunity on this front, and that is for pension funds and stakeholders to work collaboratively. So on the West Coast, the states of California, Oregon, Washington, and also the province of British Columbia are collaborating with this exchange, working with elected officials, government agencies, and the pension funds to figure out how to, really open up the deal flow as well as to come up with the financing and then sort of pool on resources on the technical side as well in order to sort of meet the demands on the West Coast. And I think that the collaborative approach, looking at this from a regional basis, is very hopeful and hopefully one that we can also emulate in other parts of the country.
Yeah, this is Marietta Mashashvili with TIAA-CREF. I fully agree with some of the commentary right now. I also want to say that we all realize that the U.S. infrastructure market is in very early stages of development. And as such, we're all going through growing pains. You're absolutely right on the resource comment, where these are very heavy resource asset class from the perspective of analysis, even screening, underwriting, and closing of these transactions. We also haven't seen a lot of the deal flow in the U.S. market, so that goes kind of in circle for a lot of institutional investors to say whether they should be committing a lot of resources to this asset class. From our observations, a lot of platforms that have been established in the pension fund community were almost forced to go outside. If they were established in North America, they had to be really looking at Western Europe or Australia because there wasn't enough of the deal flow in North America. And despite the fact that we have almost 33 states right now passing through PPP legislation, we really haven't seen a lot of states acting on them.
Thanks, Marietta. And Petya, did you have anything to add there?
I would like to further develop one point that Vonda made, which is essentially she talked about P-style investing of some of the funds. And I think the challenge that we are facing is essentially how do you access, especially core infrastructure, which leads itself to lower returns. And when you have the fund model, clearly that's an additional layer of fees. Now, what else can you do? And both Marietta and Vonda talked about that, the expertise that is required to go and analyze the deals at an asset level, in other words, being more direct. And I think that's a huge challenge. How do you access infrastructure, and what returns make sense, what fees make sense for these returns? For us, we are still in the beginning of the program, as I mentioned, and the way to go would be initially through funds, but we will be thinking about potentially co-investments as a way to gain more control over the portfolio and also have a more cost-efficient structure.
Thanks, Petya. And we've had a question from the audience, actually, which I think fits in quite nicely here in terms of talking about what kind of investments you make to make sense for your return. And that's, what is your guys' perspective on greenfield projects versus existing projects with established cash flow? I mean, Petya, perhaps you can address that first of all.
Sure. The way our policy works is that we would invest in different strategies, core, value-added, opportunistic, and greenfield infrastructure would fall into the opportunistic bucket for us, and we would seek higher returns relative to the brownfield. So we would invest in both, more limited in greenfield or opportunistic, more generally speaking, but we do understand construction risk, so this won't be a barrier. We are not saying we're not going to invest. We're just going to undertake the necessary due diligence to understand how our fund managers, as I mentioned initially, will be investing through funds, how our fund managers are mitigating construction risk or any development risk that there may be in a particular deal.
And Marietta, I mean, do you have a similar outlook on that?
Yes, we have been involved as a fixed income investor in construction of various projects. So we're very comfortable with construction risk. We would not be taking development risk, however, but a portion of our portfolio does have a greenfield risk. And again, this is more of a portfolio approach. We find that there may be a good opportunity to enter the core infrastructure space at the greenfield point if you have sufficient mitigation through reputable parties' involvement and contractual arrangements. So we have a variety of assets in our portfolio. However, we are focused on delivering the current yield to our participants over time. So obviously different projects have different duration of the construction risk as well. I just also wanted to maybe comment on some of the things that have already been mentioned in respect to whether we should source the transactions on a direct platform basis or through fund and co-investment model. It's really a complex decision, but really it needs to be decided by each institution and each institution's senior management, because when you have a co-investment model, there is less of a control over the financing structure that you would have or the time of the exit, because usually you would have to give up the right to hold the investment longer term. You would have to be probably dragged with the controlling shareholder that you're co-investing with. And whether you're investing directly or paying somebody a fee, the key, I think, even in fund investing, as we discovered, is to make sure that the fees that are being charged by the management are actually used for running the advisor, running and paying resources versus having a profit center. So whether you do it directly or outsource it, cost has to be comparable.
Okay, thanks, Marietta. And then that brings us quite nicely to talk about sort of these government-led infrastructure platforms. In terms of how institutional investors can access infrastructure opportunities, but also how on the supply side, sponsors can access alternative sources of financing. The Chicago Infrastructure Trust earlier this year issued its first RFQ to private bidders for a social infrastructure P3. I mean, that's the first example of this kind of platform, and Vonda's obviously mentioned the West Coast Infrastructure Exchange as well. Perhaps, Julia, if you could talk us a little bit through the Chicago Infrastructure Trust and what this platform means as a way of trying to get private institutional capital into infrastructure.
Oh, right, great. So PFM is the pro bono advisor to the Chicago Infrastructure Trust. It's a project that we're really excited to be part of and to be working on for the City of Chicago and with the trust board members. Just to take a step back, we find it a really important development in Chicago and across the country. It has great broad political support within the city, and it's a great opportunity to really institutionalize the infrastructure bank concept on a local level. And we know it's being watched. We're getting inbound calls from all of our clients to say, is this something that we should do, and how does it work? Now, that being said, we're kind of in the throes of really trying to figure out the structure and how it works and how it relates to the City Council, how it relates, what projects it will take on, how these projects come to the Infrastructure Trust. There's still a lot of issues that need to be worked out, and it's a little too early to tell what the end structure will look like. Right now, the current projects are energy efficiency projects that have emanated from the city, that they're great needs for the city. But we're also getting inbound, unsolicited ideas from different funds, different firms, different people. So it's really been a challenge to try to figure out the structure and how what the process looks like. So we're really excited. We're really encouraged. I wish I had more news to tell you on how the actual process, standardized process is going to work, but we're currently in the middle of that. We did issue an RFI, I think it was about 6 weeks ago. We're meeting with bidders to get their input. And I think that once we can get our first transaction under our belt, we'll have the process down, and it will be a lot easier, a lot easier for us to, I guess, comment on how it works and how we see it working in different cities or different states around the country.
Great, thanks, Julia. And I mean, how do you think this could work in other states? I mean, talking hypothetically, do you think this is a model that could be transferred to other states? And is this a viable way of facilitating institutional investment into infrastructure?
I do, and I think if not for, which is a whole nother topic that we haven't talked about, is actually the trust investing in their own projects, which let's put aside for the moment. I think that what it does is what I discussed before, is it really creates a transparent process that the public is aware of and that's completely vetted. And I think that that is critical in making sure that this new and developing asset class has a model by which is standardized, that how the deals are done are standardized, and so that the public really understands how they work and what the benefits are. I mean, I think, in the past, P3 has just been a very scary word for many of our citizens. They see it as a grab of an asset that the entity loses control of. But there's so many parts of it that could be so beneficial to cities and states with the risk transfer, and many businesses that really cities and states don't necessarily need to do, that are really not part of their core mission. So I do think that for that reason alone, it's an idea and a concept that could and should be emulated by other cities and states. But once again, like I said, once we have a format and a process, it will be a lot easier to, just to pick that up. It won't be the same everywhere, but at least we'll have some structure. And like we said before, it's P3 in the United States is still new and a developing asset class, and this will help standardize it and make it, I think, more accessible to many other places all over the country, and which in the end I think will help with deal flow and pipeline, which is what my colleagues on the phone really need in order to be successful in the United States in infrastructure investing.
That's great. And yeah, it'd be interesting, Marietta, Petya, Vonda, to hear from your point of view, I mean, from the investor side, do you think these sorts of initiatives, these sorts of platforms will help you to access infrastructure as an asset class?
Well, this is Vonda. I'm speaking, I guess, not so much from the investment perspective, but just from the public good. I think that what Julia mentioned about the public process is really important, and why everyone's watching Chicago so carefully, because I think people are they're deeply suspicious of, some are, of P3s, and there have been some, disaster is maybe too strong of a word, but some that haven't worked out so well. And so, unrelated but similar, in my neighborhood, I live in Brooklyn, there's an effort to sell the local hospital as well as the library, both of which the land would be used for private development, condos. And people see that sort of thing happening around them, and they wonder, you know, what's happening to our public property, our public assets, and how do we go through this transition in the U.S. that we protect our schools, our hospitals, our roads, our bridges, our parking meters, our parking garages, get the repairs needed, and then build for the next century, you know, build for the new, hopefully sustainable economy of the future, at the same time not turn it all over to the private sector, which is viewed with some suspicion. So I think that's the challenge in front of us, and, you know, I guess to put the pressure on Chicago, why it's being watched so carefully, and hopefully it does serve as a model for other parts of the country.
Great, thanks, Rhonda. No, go ahead, please go ahead.
Marietta Mashashvili, I wanted to say that I fully agree with some of the commentary made about standardization of the process. We actually have a benefit of learning from other developed markets. Obviously, the PFI model in the UK and other countries like Australia and Canada having PPP models established in a lot of even social infrastructure subsectors that have higher political risk in the US. We're careful in analyzing reputational and political risks every time we get involved as an equity investor in infrastructure assets. So if there is a way to set out the positives and the negatives and establish a standard model prior to any particular institutional involvement, that's only a positive as it's being perceived from our standpoint.
Great. And Petya, did you have anything to add there?
I would just echo the comments that were made, and I think it's a little bit early to say how the Chicago Infrastructure Trust will develop, but I hope it does serve for a model.
Okay,
it's Julia,
great.
So do we.
And let's talk about you know, investment strategies. We've talked about how you might, you know, that there's a demand for alternative sources of financing, and that institutional investors are interested in funding infrastructure. But now, and looking at what defines infrastructure, but it'd be interesting to know, you know, what are the strategies of institutional investors? I mean, is there a pressure, first of all, to invest within the U.S. or within your own state? I mean, I know that some of the Californian pension funds have chosen to put large allocations of investment into Californian infrastructure. I mean, Petya, perhaps that's a question I can ask you. Do you feel that there is a pressure to invest within the U.S. or within the state of New York itself?
Our program is a global one, and I think that the issue with investment in the U.S. is what have been localized in this conversation, which is that there is still not enough deal flow. In New York, we still lack P3 legislation, and although there are some deals in the market like Gothos and LaGuardia that have been very well publicized, that's not enough for an institutional investor to deploy capital. And in addition to that, as an institution, we are investing through funds, so it would be difficult for us to invest in a project basis for the reasons already discussed, more specifically resources. So I think that in terms of strategies, that's why we have a global program, so that we could invest and generate the returns for our pension systems that we need. Otherwise, again, there is just not enough deal flow.
Yeah. Okay. And Rhonda, I wonder what your view is on that. because I know you mentioned those projects in Brooklyn, and there's obviously a need for development of U.S. infrastructure. Do you think that there is almost a necessity that pension fund money from the U.S. should go into U.S. infrastructure?
Well, I think that the way that the California Fund, CalPERS in particular, and CalSTARS as well, have approached it is probably the best way, and that is they have a global program, but they are seeking out California-specific investment opportunities. And so I think the challenge is really to do both. And then the challenge on top of that, as Marietta mentioned, is that we really don't have, we're in this transition phase where we really don't have the opportunities to invest yet. So we can get all ready to do it, but then there also has to be deals that meet the needs of the pension fund. And so, the challenge over the next couple of years is for us to sort of build up a program here in the U.S. But I think that you're going to find the funds are going to look to do both. And I think that the pressure, it's interesting to sort of hear talk about, a national infrastructure bank, other related government parties trying to figure out how to, deal with the lack of funding in the U.S. There's always this sort of interest in going to the pension funds, like, oh, we should be able to go and they should be ready to do it. It's such a great idea. But then there's just no structure set up in place to do that. I was sort of interested to hear, last week I met with a group of South African trustees from the pension funds there, and they have the same thing. The government there has said, oh, the pension fund should be investing in our infrastructure needs in our country. So I do think that probably globally the pressure is there, but the structures haven't sort of been built up yet, and hopefully they will be to meet that kind of demand. So ideally, you would find pension funds being able to invest in their own state, but not exclusively. So I think you're going to have to continue to look for that diversification.
Yeah. And Marietta, did you have anything to add on that point?
Yeah, I think these are great points that people have mentioned already. I think there needs to be a desire by government officials to also change some of their approach to how they are running RFQs and RFPs, to encourage institutional capital to participate in the processes if they would like to do that. Because we've obviously seen some developments in the UK where there is an ongoing dialogue between governmental officials and pension funds that are local in the UK. I'm not so sure we have a lot of that in the US. We're obviously starting to observe that. But I think it would be great to establish some mechanism by which there would be a continued dialogue so that there would be a facilitation of participation. Because right now, I think a lot of it is designed for strategic players, the construction companies that would be equipped to deal with that.
Okay. And great. And I mean, if we could delve a little bit deeper into the investment strategy. I mean, so we're saying there needs to be a mixture of investment in the U.S. in certain states in particular, and also further afield. One question we've had from one of the listeners is, what sort of characteristics do U.S. pension funds look for in possible emerging market infrastructure partners? I mean, what are the main concerns if they're looking to invest in emerging infrastructure projects in emerging markets? I mean, Marietta, perhaps you can start us off there.
Sure. In general, every time you have local investment team invest outside of the country, there is a question on hedging that's typically asked of us. And it's very hard to hedge these assets because these are equity investments, and you really, while you have projections, but you really don't have as much predictability as you have with the bonds, that these particular distributions or returns will be coming over particular points in time. So as you consider emerging markets, the currency question becomes a little bit more unique, obviously, just because there is less opportunity to hedge any exposure, even if it's just on the invested capital basis. And when we consider emerging markets, we also try to look beyond the local expertise and needs for infrastructure. We also try to understand the ability to approach the court system in that market, the transparency, the accounting standards, and also our relationships. We would not approach any opportunities without having a local partner that we trust, that we have done business with, because we're not on the ground in those countries. But a lot of contracts, as we all know, are executory contracts. So at the end of the day, we all have to have a comfort level that those will not be rejected.
Okay, great. And Petya, I mean, you said that you have a global mandate. From your point of view, what things need to be taken into consideration, and what are the main concerns when you're looking at emerging market plays?
A lot of the reasons are similar to what Marietta just described. We would look at the political stability of the country, track record of the regulatory system there, how the court system has performed, if our fund managers are going into these markets, what is the history, the track record that they have had there, do they have a local partner, and as Marietta mentioned, hedging is an important consideration, although I would expand that consideration to non-U.S. markets generally, although currencies are clearly more stable in the OECD countries.
Okay, and does anyone have anything else to add on that point? Okay, so I'll move on then. In terms of energy versus infrastructure, what kind of investment strategy are U.S. pension funds looking at? Are we mainly looking at trying to meet the demand of, rebuilding aging infrastructure within the U.S., or are we also looking at energy opportunities, or is that considered to be outside of what would be within investment mandate for a pension fund? Marietta, what's your view on that?
We include energy infrastructure as part of our infrastructure strategy. At the end of the day, it will have to meet characteristics that I talked about, and they relate to the stability of the cash flow and predictability. We also have an energy platform, and we are priding ourselves on the fact that we are collaborating between energy and infrastructure platforms. This was done on purpose because, from our experience, contracts obviously work, especially in the developed markets. Having said that, we don't want to have a risk of termination of the contract over time if, in fact, there is a question about business arrangement or longevity of the contract for economic or energy-related reasons. So we usually collaborate with our energy platform on whether a particular contract makes sense over the longer term. But we have invested in contracted power. We've invested in, as part of the infrastructure strategy, I should say, invested in contracted midstream that had volumetric guarantees. So we definitely consider energy infrastructure to be part of our strategy.
Okay. And does anybody have anything to add on that point? Well, I've had another interesting question from the audience, and this kind of looks more at the infrastructure debt side of the business, which I think is quite interesting, and it comes into how that is differentiated from the fixed income asset class. And the question we've had is long-term floating rate project finance debt a possible institutional infrastructure asset class if the yield targets can be met? And if so, how do such loans fit into alternative versus fixed income buckets? Petya, could you give us your views on that point?
Sure. From our point of view, the way we would potentially invest in debt, which our policy gives us the opportunity to do, would be again through funds at this point. And debt funds have been emerging over the last few years, and from that perspective, yes, it is possible that we would invest in debt. There is nothing to prevent us from that, and there are some options in the market. The challenge would be, as you implied, the return. We need to meet a benchmark, and the question would be whether or not this investment would meet this benchmark. Clearly depends on whether or not the debt is senior or mezzanine, so the return profile would be different as well. Also, another way to look at it is from a risk perspective, and as I mentioned, we are at very early stages of our program, but if we have made investments in equity, maybe there will be a role for that to provide a more stable stream, more stable return, although it's a lower return given the risk.
Okay, and I mean, Julia, the question for you, does that meet with the demand on the supply side? I mean, are your clients looking for, you know, pension funds to provide this long-dated floating rate financing?
I'm sorry, could you repeat the question? Do
Sorry,
our clients...
Are your clients looking for investors to provide that, you know, that long-dated floating rate financing for projects?
Yeah, I mean, you know, like we've talked about it, our clients are very new in the process, and you know what we, I don't think that we spend a lot of, I mean, we want to know what the overall cost of capital is for them in the end, but how that happens is not something that we're as concerned about. Once we can get all the stakeholders on board and we can hammer out a concession agreement, what we're looking for at the end of the day is a number, or a profit share or a revenue share over time. So you know, once again, our clients are looking to compare it to their lowest cost of capital, which is really doesn't necessarily make sense given all the risks that they're transferring. But our clients are just really looking to see what the number is at the end of the day, and how our counterparties get there is not something that we're as concerned about.
Okay. And unless anyone has anything to add on that point, I've just had another interesting question. Oh, please do go ahead.
Yeah, this is Marietta. I want to say that part of our strategy and has always been that we can structure our investments in different forms, and those would be, though, on the fixed income, fixed rate basis. We could be a mezzanine debt provider. We could even be a senior debt provider. If it's a below investment grade opportunity, we could structure in a preferred equity basis or convertible equity basis. The reason behind that is understanding the risk profile of each particular investment and design the best risk-return model for our portfolio. We also have a group that does investment grade rated project financing. We're more of a fixed income and fixed rate lender because of the nature of our liabilities. Floating rate question typically pops up, and usually for developers and the sponsors, and now as equity participants, we can understand the benefits of having a floating rate debt because of the optionality of the prepayment. However, having said that, given where the rates are today, we also see a lot of demand for the fixed rate financing over the longer term.
Okay. Okay, great. And we're coming towards the end of the session now, so I'd just like to kind of do a sort of quick roundup of what your views are on how we can really move things forward now and really create a market where institutional investors can get involved in investing and funding infrastructure. I mean, perhaps Marietta, if I can continue with you and you can give me your views on, how we can really move the conversation forward now.
I think this platform and this type of a dialogue is very helpful for each of us to learn about aspirations of each institution. What we're trying to do is to have ongoing dialogue with other financial investors that would be considering infrastructure as an investment from the private equity perspective. We also would like to encourage the dialogue between public sector and private investment sector. Given some of the particular challenges we've discovered in trying to get to be on equal footing with strategic players competing in bidding for those projects. So I think those two things would probably go a long way. And also understand whether the transparency that everybody talked about that is starting to be established through different forms of trust and actually go forward with more states and on a federal level where there would be more of a model that institutional investors could relate to and be comfortable with.
Great, thanks Marietta. And Vonda, if I could come to you next.
Sure, I think that what I have to say is just really a continuation, excuse me, that we're really at the stage of we've established the need, it's clear in everybody's minds, there's all sorts of opportunities out there. I think pension funds are looking for a lower risk type of investment and long term, which this meets. And so the question is, how do we get past this, we've never done this before, to sort of build up our own expertise. So the dialogue between, at a federal level of the government as well as state and local government, other key stakeholders, including the labor movement as well as the public sector, and then, bringing in the private sector in the way that they know how to finance deals and figure out how to do something that we haven't done before, really. I also think that from the institutional investor perspective, there's a whole set of people that work around the pension funds that need to step up, including our consultants and other service providers. And so, it's a challenge. And if we sort of sit back and say, oh, gosh, it doesn't really fit with what we've done in the past, or we've never done it before, I think we're all going to lose out, and there is sort of a new opportunity. But I think that the challenge we haven't met yet, and it's going to require a whole lot of kind of new innovative strategies and structures that I think are illustrated by the West Coast Infrastructure Exchange and the Chicago Trust and others that have been sort of experimenting, and then we can learn from, I think, our brothers and sisters that have done this around the globe, in Canada and Australia, in Europe, and figure out what the U.S. model is going to look like.
Great, thanks Vonda. And Julia?
Yeah, I mean, I agree with that. What Vonda said, what we're finding too is the engineers like the CMH2M Hill, I'm sorry if I butchered the name. I mean, they're on the ground, right? They're already taking risk, and they know what projects are being worked on. So we're finding that there's a lot of strategics getting involved in water, wastewater, because the engineers are already there working with our clients. We're trying to facilitate dialogue. We had the head of the trust meeting with different infrastructure funds and private equity firms in New York to try to figure out, understand what each particular fund is looking at, what their sweet spot is, how much equity they're looking to put in. And I think that I do believe that over the next few years, as we continue these dialogues, we continue the dialogues with the public officials, create the transparency with the citizens, that there will be deal flow. I'm really encouraged this past year, as opposed to many years where we just saw the capital need. We're actually seeing clients want to talk about alternatives, like I said. That being said, this is not something that we go in and recommend for every client that we have. We always do a study with them up front to show them what the policy risks are, what the policy considerations that they need to make, and what those mean in terms of dollars to them. So I think as we continue to work with our clients and start the discussions early, I do think that we will get to a process. It might be different, slightly different in each sector, as well as slightly different in different parts of the country given the P3 legislation, but I do think that we will get there.
Great, thanks Julia. And then finally, Petya, if you could just give us a few brief remarks.
I think two main things. One, the dialogue between the public and private sector, so that there is a sufficient deal flow for the private capital to invest in institutions or other capital. And number two, continuing the dialogue among the pension funds and other stakeholders so that there is an increased education, awareness, and also ability to access the infrastructure asset class.
Great, thanks Petya. And we've come to the end of the session now, and I think you'll all agree that it's been really interesting talking point, and we could have gone on for hours because there's so much to talk about in this space. And I think it's a really exciting market at the moment, and it will be interesting to see what the next year or so brings. If you've enjoyed this session, please join us for our Institutional Investor Forum in New York in June. If you'd like more details on that, you can contact our Events Director, Jessica Taylor. Her details are now on the screen. But for today, I'd just like to say thank you to our panelists who've made this a really engaging debate. So thank you, Vonda. Thank you, Marietta, Julia, and Petya. Thank you very much. Thank you.